Hello, everyone, and welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Jason Natick. Another chapter of American history was written on November the 5th. Donald Trump and the Republican Party secured what many are calling a resounding victory in this week's U.S. election, clearly winning the U.S. presidency, flipping the Senate, and looking like they're closing in on retaining control in the House as well. Now, the administration is looking to move its agenda for the country forward, and investors are wondering what that means for their portfolios. We're going to dig into that in today's session, what the government's key policy priorities are, how the economy and financial markets might react, and how investors can consider positioning their portfolios to take advantage of these shifts. But first, I just want to take everyone through a quick brief tour of our broadcasting platform here so we can all get the best viewing experience possible. All right, first and foremost, where you see me, you'll have an opportunity to adjust the video controls for your own personal viewing pleasure. You can adjust the size, you can move it around, you can go full screen if that suits you best. All right, next I want to highlight on the left-hand side of your display, we've got some important resources and links. We've got links to our guest website. We've even taken time to link to some of our archive previous Inside Investing shows. You can click on those to kind of continue your learning beyond today's kind of hopefully fruitful discussion. All right, the next thing I want to highlight for everybody is the Q&A box. This is where kind of the rubber meets the road. We've got a great conversation planned with myself and the guest, but the really cool thing about these shows is that they are interactive. Go ahead and get your questions into the Q&A folder. I want to shout out to those folks that are joining us on YouTube. Yes, that's right. We're broadcasting live on YouTube as well. If you want to join in on the polls we've got planned for today's session, as well as the Q&A, take a look at the link in the description. That'll bring you into our platform so you can engage us in that manner. And last but certainly not least, I'll highlight below the video. That's our upcoming Inside Investing shows. We always have a full docket of shows. We put a lot of blood, sweat, and tears into bringing forward for everyone out there. If any of those topics are resonating with you, please don't hesitate to subscribe. Come join us. We'd love to have you. But rest assured, if you're not able to make a live presentation, that's okay. All of these shows are archived. We typically have them up usually within about 48 hours after the live date. Also, they're on our YouTube channel as well as in the Learning Center in our web broker platform. All right, so now it's time to welcome our guest and get down to the topic at hand. Joining us is Bipan Rai. He's the head of ETF strategy at BMO Global Asset Management. Great to have you here today. Thanks for taking the time.
Thank you for having me.
A question for you. How late did you stay up on Tuesday? Did you make it into the wee hours in the morning, or did you duck out a little early?
I stayed fairly late. I mean, as usual with the prior elections, it tends to be a late night and early start to the morning, so there wasn't a lot of sleep to be had that night.
Yeah, I was the same. I kind of was watching, and then when the popular vote really was going the way that it went, and some of the kind of eastern battleground states really didn't turn out to be much of a battleground, that's kind of when I called it a night myself.
Yeah. I mean, it really looked like if you looked at the polls or at least the counties that Harris was winning, the margin was certainly not as good as it was in 2020. I mean, that was certainly the case in some of the other battleground states that we were looking at, including North Carolina and, of course, Pennsylvania. And right around then, you kind of got the feeling that things were going the way Democrats
you could see the momentum building. And, North Carolina and Pennsylvania were the two that really stood out to me. Pennsylvania in particular, that was a big shift from 2020 as well as 2016 as well.
Yep.
All right, so just a kind of general overview of it, but what was your initial reaction to the results of the U.S. presidential election? Was it surprising to you how things kind of shook out?
Not exactly. I mean, I guess the surprising bit was the popular vote, but a Trump victory and a Republican-controlled Senate. I mean, those were within the realm of possibility. Now that the House is looking more and more like it's going to stay in the control of the Republicans, I mean, it's still something that the market did factor in as a very likely scenario going into the election. That could have been reflected as well, or was reflected in the betting markets as well. So don't want to say that it's as big of a surprise as, say, 2016 was, but certainly I can imagine that more than a few people were somewhat surprised by it.
Yeah, there is, even if it was certainly runaway is not the term to use in this. It was more of a resounding victory, but there was still there's still quite a lot of support on the other side of the aisle. Do we think this is the first time that that Trump as a candidate has won the popular vote? Will this be something that will kind of propel him to really enact kind of what he's been speaking about on the campaign trail?
I certainly think it brings, or at least it will lead to more rhetoric that the wind is beneath his wings, let's say. Well, or at least the Republicans have wind in their sails to enact some of the legislation. Now, could some of the other sort of long-term sort of ideas that he's been running with become institutionalized? That's the real risk to watch for. I mean, this is really a vote of confidence that the American people have given to Trump and the Republicans. So, everything we need to keep an eye on, including tariffs, immigration policy, trade policy. I mean, these are items that could become part of the institutional fabric of the United States, and this could outlast this term. This could potentially be a bipartisan rallying cry forward. And I would say that is this a change election in the same vein that 2016 and 2008 were? It does feel that way right now.
Right. Yeah, you got a sense there's something maybe generational going on here. Now, obviously, there's still some House seats and races that are yet to be decided. Do we think they're going to have any influence to affect the balance of power with the results going forward?
Yes, absolutely. I mean, if we do see the Republicans retain control of the House, that means they've got 2 years to enact some of the key legislative bits that they've been talking about. Now, I'm not going to focus too much on tariffs because, remember, in the 60s and 70s, Congress basically ceded a lot of the power when it comes to tariffs to the office of the executive. This is really about whether or not the Republicans under Donald Trump can enact measures with respect to what they've been talking about with massive deportation of both illegal and legal immigrants, and also potentially with respect to trade policy as well. So, I mean, that's really going to be, in our view, the focus for the Trump administration, at least in this first 2 years. If they do retain control of the House, it does give them a lot of room to potentially run with some of the measures that they've been talking about. Now, working with the Democrats will still be necessary, given the fact that they, as they did get control of the Senate, they still don't have the 2/3 or at least the 60% majority to overrule the filibuster. So again, that's it's not a complete loss for the Democrats, but this does feel like a 2016 repeat.
Yeah, that word, the filibuster, it's a funny one to begin with, but it does rear its head when we're starting to get into many of the divisive issues and big sweeping changes that we've heard about. So yeah, that 2/3 majority could be not having that could be significant. Now, absolutely. You've analyzed, did you have a follow up to that? Sorry.
No. I was agreeing with you.
All right, great. So you've analyzed kind of how presidential elections have impacted markets in the past. How consequential have you found that those results can be on markets and, by extension, investment portfolios?
Certainly. I mean, if you look in the past, if you have the same party winning both chambers of Congress and the presidency, those typically tend to be correlated with market movements that are a little bit more volatile. And again, the most recent example of that was 2020 and 2016. And both of those were really wave elections, in which case 2020 was the blue wave and 2016 was really the Republican wave. 2016 was a bit of a shock. And again, what we saw was the market was very, very quick to discount some of Trump's measures that he talked about back then, including the tax cuts. And of course, in the initial 3 months following Trump's electoral victory over Hillary Clinton, we did see the S&P 500 rally quite aggressively, and that continued into the latter half of the year. Some of the sectors that outperformed during that cycle could be the same sectors that potentially could outperform this cycle, including financials and technology. So again, there are instances where we have seen a resounding, electoral victory means something quite significant for the markets, and certainly when there's the implications when it comes to taxes, when it comes to tariffs. These are the things that markets pay attention to.
And there's been some short-term bounces as well. I know on election day on Tuesday, the market was green, and yesterday up quite significantly. Should that have been a surprise based on the eventual results?
To a degree, yes. I mean, we did see some of that pricing going into Tuesday night, but let's remember that I don't think the market was fully ready for the Republicans gaining control. Pricing in a complete red wave feels like we're getting closer and closer to that. Now, that doesn't mean that we're not going to see an additional rally when it comes to stocks or even additional upside for the U.S. dollar. But again, if you look at some of the measures that Trump has discussed in the past, including tax cuts and including potentially extending those tax cuts that are set to expire at the end of 2025 for another 10 years, that's a huge boon to the U.S. consumer that already has is starting from a relatively enviable position when it comes to their balance sheet. So, that could mean extraordinary things for the U.S. economy and by extension for the U.S. market as well. So, for sure, this election has meant a significant amount for the markets in general. Is there additional upside potentially from here? Certainly. But again, we need to see what the House final tally for the House looks like and whether or not there's a clear path for Trump and the Republicans.
All right, great. So we're going to take a bit of a pause and for a little pause in the action for a little bit of fun. I've got a trivia question for the audience. Let's bring that up on the board. I think everybody should be seeing that now. Saying the trivia question is, what type of political environment has the S&P 500 index performed best under? Based on historical data, we're going to be looking at a time frame from 1926 to 2023. Is it going to be A, Republican president and Congress, Democratic president and Congress, or will it be when we've got a bit of a split? We've got Republican presidents and a split Congress, or they're taking the other side, Democratic president with a Republican Congress. Go ahead and cast your votes, and we'll reveal the answers in just a moment. Without revealing the answer to you, Bipan, do you have an idea of how we think this might shake out?
I don't actually, but one thing I think is very important to consider is that the changing nature of the two parties over time, right? I mean, if you look at the Republicans and Democrats of 2024, they're not the same party that ran on the same sort of core system of beliefs as they were in, say, the 1960s, and certainly not since the 1920s. But it's an interesting trivia question. I suspect if I did have a guess, I'm going to go with either C or D. I'm going to say it's probably C, but let's see. I could be wrong.
Okay. Interesting take. Yeah. Now, let me get your take on, just while we're waiting on votes to kind of come in. What do you have a take on, like, the total dollars that are spent on the U.S. election? Both because we know there's the top ticket gets lots of hundreds of millions of dollars, but then you've got Senate races. Like, how does that impact, or is there any other trickle down effect to like an economy or like an investment portfolio based on that just sheer dollars that we've got being thrown around?
Do you mean in terms of both parties spending on advertising and the like during a campaign, or is this more?
Yeah, advertising and all the other infrastructure to the parties and things like that, I guess,
Yeah. I mean, certainly the amount of money that's spent creates a huge barrier for really any sort of meaningful shift in terms of how the U.S. electoral system is run. We did have this question on the desk as well in terms of guessing how much was spent, and I know the answer is close to just over $10 billion for this past election cycle. But again, you think about both parties; both of them have heavy financial backers. The length of the electoral cycle in the United States. I mean, it's not that surprising that we see over $10 billion spent when it comes to advertising and the like. So, now how does that translate into financial markets? I'm not sure there's much of a connection, to be honest with you. I think that's more of a sort of question about the nature of U.S. politics and how really advertising and big corporations and big sponsors really drive the message overall.
All right, great. Okay, thanks everyone out there in the audience. We appreciate everyone who voted. Let's check out and see what everyone thought here. So the top results that we got was a Republican president and Congress, with Republican president with a split Congress coming in second. Let's take a look at what the actual answer is. The S&P 500 index has historically performed best with a Democratic president that has a split Congress. So it went completely off the board a little bit. That answer didn't get actually any votes from the audience, meaning that Republicans controlled at least one of either the House or the Senate. The index returned an average of 16.63% annually during the 15 years this dynamic played out. The next best result was a Republican controlled all three of the presidency, House, and Senate. So some pretty interesting results. And the index return on those periods was about 14.5%. I guess everybody was wrong in this one here, Bipan. What do you say about that?
No, it's interesting. And I suspect that the Republican unified government, a lot of that came under Trump's last administration, because we did see outsized gains between the period of 2016 and just before the pandemic. So, that doesn't surprise me. I guess the Democratic president split Congress does surprise me to an extent. And, that's something that potentially we'd have to look at the data and really assess under which presidency that came under. One other thing I should mention, I mean, the common sort of dividing factor that a lot of people tend to look at when it comes to Democrats and Republicans is that Democrats like to tax and spend, and Republicans like basically working and being fiscally prudent and responsible. It's interesting. If you look back to the 1980s, though, that's not the case. You've actually seen the deficit widen and expand more so under Republican presidents relative to Democrats. Now, that's not a partisan answer. That's something that's actually been reflected if you look at the budget deficit as a percentage of GDP over time. And, there's different reasons for that. But, that's why I'm kind of always, when people mention that, I'm always like, look at the data and, just make sure you take your biases out of it when we're talking about markets and the like.
And the interesting thing about those numbers as well, and this might be just kind of politics in general, even if those numbers stated that it was a Democratic president, well, then you might have Republicans on the other side saying, well, it was the policies that we put in place before the Democrats took over that led to this, and you're going to have that push and pull from both sides of the House.
Okay. I agree.
All right, great. So let's dig into what those U.S. elections might mean for markets and how investors can consider positioning their own individual portfolios. So, which sorts of federal government policies tend to have the biggest impacts on financial markets and the economy?
Right. So there's two that I would point to. The first one is naturally taxes. Now, of course, in 2017, we had the Tax Cuts and Jobs Act. That was well anticipated by the market because Trump ran on it in 2016. And by and large, we did see it. And that was one of the reasons why we had the S&P rally to the extent that it did towards the end of 2016 and well into 2017. So again, that's one measure that markets tend to look at, especially corporate tax cuts. And they tend to discount other measures, including deregulation, can be important for certain sectors as well. Now, in 2016, we did see Trump run on that. He's certainly run under that banner as well for 2024. And I do suspect that a lot of that is filtering through into the price action for where we have markets right now, not just in the equity market, but also potentially for the U.S. dollar and for the long end of the yield curve. So, those are the two that I would point to as being potentially the most, having the most gravitas when it comes to the market and potential impact or pass through to the market in terms of policy making. But there are other sort of slower burn policies that could potentially be factored into the markets more so over the long term. One of them is, of course, trade. And again, tariffs are a big, part of the zeitgeist right now, especially when it comes to U.S. trade with China. An increase in tariff, in theory, should lead to higher inflation. Now, we did see that to an extent when Trump did levy some of those heavy-handed tariffs on China, and of course, vice versa did happen as well. And we suspect that he does pass through, or he does follow through with his threat to increase tariffs on Chinese imported goods, close to 60%. Now, over time, that will filter through to inflation, and that will matter for the market as well, because in essence, if you're talking about corporations and rising input costs, that does take a bite out of the margins, and that does also, of course, filter through to earnings. But that's more slower. That's a longer-term theme. And that doesn't get discounted nearly to the same degree as, say, tax cuts or other changes to regulations do.
Now, you mentioned inflation, and we've got obviously a big announcement coming later this afternoon with the Fed expecting to cut rates today, and there's some that are concerned about maybe the independence of the Fed and Trump and Jerome Powell's kind of prickly relationship, if you will, over in past years. How do we think that's going to play out, or what impact do we think that'll have on the Fed's independence as well as kind of rate decisions going forward?
Yeah, so I mean, if we look at Trump's policies in sort of a vacuum, and we look at tariff increases, the easy answer to that is that they're inflationary, right? That makes sense. If we're talking about potentially taking or like distorting the labor force by deporting legal and illegal immigrants, that could potentially be disruptive to the labor market and also raise inflation as well, given the fact that potentially you have fewer sources for labor inputs or for employers to choose from that could pass through via the wage channel. So, we're talking about potentially inflation becoming a more thornier issue for the Federal Reserve going forward. And what that tells me is that over time, if we're looking at the equilibrium level of interest rates, potentially there's more of an inflation premium that needs to be calibrated or priced in, and potentially the Fed leaves interest rates at a higher level as opposed to being, closer to where they regard the neutral rate to be. And, to a degree, we've seen that since Tuesday. Certainly, if we look at the way that, what we like to call the forward swaps market is pricing the Federal Reserve going forward, they're pricing them close to end this interest rate cycle close to 3.75%. That's higher from 3% that we had just over a month ago. So, that's the way that, we think that the Federal Reserve is impacted by Trump's decisions. Now, we should also mention that, there are some supply side themes that could be picked up on with respect to Trump. And of course, some of that comes in the regulation side of things that could sort of curb some of the inflationary pressures from, say, his trade policies and also from his tax cuts. I didn't mention the tax cuts, but that also does have an important bearing when it comes to consumer spending power and potentially inflation as well. Now, with respect to Trump and what he will do with Chair Powell, obviously, he did appoint him, I should mention, before the pandemic to that office of Fed chair. But he's also been very critical of Chair Powell, most notably when it came to some of the decisions that he made towards the end of the last decade, and maybe it wasn't cutting rates or being as stimulative as Trump would have liked. So there's certainly a Richard Nixon type element. If you recall, Richard Nixon did do that did exert some pressure on Fed Reserve chairs decades past. But, here's the other thing. Chair Powell's term ends in 2026, and means a very, very thorny issue for President Trump legally in terms of firing the Fed chair. Remember, Powell does also have a position on the board that's separate from his position as a Fed chair. And, there are some implications there from a legal perspective that could make things a little bit more drawn out. So the view here is that Trump is just better off, if he wants to get rid of Jay Powell, to let his term expire in 2026, as opposed to really being proactive in firing him sooner.
That'll be one of many kind of interpersonal kind of dynamics that we'll be watching closely over the next, weeks and months and years, clearly. All right. Now, by many accounts, the U.S. economy performed strongly under the Biden-Harris administration. In some cases, it was due to their policies, and others, it might have been due to more secular factors. How likely is that trend to continue under the new administration, in your view?
I mean, in terms of the economy, we have to think about really what structurally has changed in the United States over past cycles. Certainly, if you think about how restrictive interest rate settings are right now and how long they've been at these sort of restrictive levels compared to prior cycles, I mean, we should be seeing a slowdown in the U.S. economy by now. But here's the thing. If we look at household balance sheets, and really the U.S. economy is a consumer-driven economy, we saw a heavy degree of deleveraging or removal of, say, mortgage debts immediately after the financial crisis 15 years ago. So, as we got into the pandemic shock and even beyond when we got into the rate hikes cycle that began in earnest in early 2022, household balance sheets in the United States did not carry all that much debt, right? So you didn't have that same sort of saving increase where households would save more in order to service debts, as interest rates became a lot more punitive to them relative to other countries like, say, Canada. So that's been a huge safety net for the U.S. consumer on one end. The other thing to consider as well is if you look at the largest line item on the liability side of any household balance sheet, it's usually mortgages. And the United States is one of the few places in the world where you can get a 30-year mortgage and not have to worry about it until the term is up. So you don't have to worry about refinancing terms quite like you do in other countries, including here in Canada. And you better believe, immediately after the pandemic, when rates hit zero, there were a lot of U.S. households that went out and got those long-term mortgages at extremely low interest rates. That is a huge safety net for the U.S. consumer. And that's one of the reasons why, we feel that the U.S. economy has done extremely well. Can that continue going forward? Potentially. I mean, sure, there's some degree of softening that we're seeing in the labor market right now. But when it comes to the wealth effects and other income channels for U.S. households, those still remain quite robust. The consumer is set to remain strong, so we should continue to see nominal GDP in the U.S. economy remain in that 2 to 3% range. That's still quite healthy, and there's no reason to believe, at least at this point, that that's going to change under a Trump administration.
All right, you mentioned consumer debt. Let's kind of shift the focus and maybe look at that on a bit of a grander scale, talking about federal deficit as well as national debts. Many are expecting that to continue growing, I should say, regardless of which candidate won, based on some analysis done by the Bipartisan Committee for Responsible Federal Budget. How might America's increasing debt burden factor into the markets?
Well, at some point, it's going to have to. I mean, if we look at let's take the budget deficit. The budget deficit right now is the largest it's been outside of a pandemic and a war setting ever. It's remarkable that the market hasn't really priced in a premium to the long end of the yield curve, nor with the U.S. dollar. It's certainly at a point where we're seeing foreign central banks start to move away from the U.S. dollar and, by extension, U.S. Treasuries as part of their reserve holdings. Here's the thing about deficits, and here's the thing about running, large amount of debt issuance. It doesn't matter until it does, right? So, these are things that tend to become more and more amplified problems when you run into shock scenarios. It's really hard to see those shock scenarios before they come, by definition. That's why they're called shocks. Mm-hmm. But at some point, sort of a green light for the Trump administration to extend those tax cuts out for by another 10 years, that could potentially add $3 trillion to the deficit. And again, that takes us closer to 10% of GDP when it comes to the budget deficit. For me sitting here, it's really hard to see how the market will not ascribe an additional premium to the long end of the U.S. yield curve and also to the U.S. dollar in that sort of backdrop. But again, we have to go through the motions at first. We have to see what the policy that the Trump administration is going to run with, or the policies, I should say. But at the very least, if you're going to have those tax cuts and extend them out, you need something there to serve it as an offset to increase revenues. Now, so far, the Trump administration, or at least President Trump, I should say, has said that tariffs could be that offset. But there's no academic literature out there that supports that notion that tariffs can be an effective offset for large-scale tax.
All right. So speaking of the Trump administration, you mentioned the elimination of income taxes and kind of extending out those tax cuts that are already in place for an additional decade. But what about, and as well, I guess we've talked about tariffs. What are the sort of the economic and financial markets, those impacts they could have on those markets that those moves could have in your view?
I'm sorry, which are we talking about the extension of the tax cuts?
Yeah, tax cuts, as well as if the tariffs do come into play, how would we think that is going to be most impactful?
Certainly. I mean, you can expect retaliatory measures from other countries as well. So, the U.S. exporters could potentially be hit from that lens as well. So, again, tariffs, and especially if you're reorienting towards trade policy that is more zero-sum game and mercantilist in general, I mean, there's always winners and losers, especially in a country like the United States. But again, remember, the U.S. is a consumer-oriented economy. There tends to be more consumption done of imports. So, what that could mean, at least in the beginning, is that, you do have higher prices. You do see inflation start to remain a little bit more stickier relative to what we were used to in the free trade era. When it comes to potentially competition, this is extremely beneficial for some small and medium-sized enterprises that all of a sudden don't have to worry about as many competitors. And so that could be, sort of serve as the backdrop for why we see small and mid caps outperform going forward. I would say those are probably, immediately off the top of my mind, the most salient takeaways potentially from any sort of increasing trade rancor when it comes to the United States and its trade partners.
All right, another key plank in Trump's campaign was greater restrictions on immigration. Right, it was quite quite the topic during many of his rallies. What sort of impact could that have on the economy, and how might it flow through to financial markets?
Sure. I mean, if we take it from the disruption that it could mean to the labor market, you have to look at the sectors that rely heavily on, migrant workers. The first one that comes to my mind is, of course, construction. Construction, also professional business services, also potentially hospitality as well. What it could mean is that all of a sudden you're drawing from a smaller source or smaller pool of workers if you're an employer. And that could mean upward pressures when it comes to wages over the medium to long term. So again, that is an inflation that is constructive for inflation, and that could make the Fed's decision making a lot more tougher as we move forward in the coming years. So that would be the immediate sort of economic monetary policy sort of takeaway from the policy that Trump has when it comes to immigration. When it comes to markets, that's something that we need to think about a little bit more. At the margin, it does suggest that there could be some near-term headwinds when it comes to consumption as a driver but we don't think it'll be all that much impacted when it comes to Trump's immigration policy.
Okay, let's keep the focus on individual investors. So we've talked about a number of high priority policies for the administration. How can investors position their portfolios so they can benefit?
Right. So if we look at the U.S. economy in general, if we use the 2016 scenario as a base case, and I think that's a good starting point for where we're headed, then you want to remain in when it comes to the equity market there. Put simply, you're dealing with really solid fundamentals in an environment where interest rates, despite the fact that we're talking about stickier inflation, interest rates, especially in the front end, is still going to head lower, right? And that's because the Fed is operating in very restrictive territory and needs to get back to whatever the neutral level is as in an orderly fashion. So that's still, that forms the guts of a very, very meaningful and constructive market for equities. Now, what we saw in 2016 was a scenario in which case, broad market exposure did do well, right? It was whether it was large caps, but if you want to look at things from a sectoral perspective, certainly financials make sense in that sort of backdrop. Energy could also be an interesting case study as well, given the fact that we are potentially talking about deregulation. And of course, one of Trump's catchphrases is "drill, baby, drill." So that could be something to consider as well when it comes to looking at things from a sectoral perspective. Other than that, I mean, if we're talking about factors, we think value and quality will continue to perform. Those would be our top picks, when it comes to factors from what we've seen over the last couple of days and extrapolating that going forward.
All right, so we've put a lot of focus on President and President Trump, but what about the makeup of Congress, meaning the House of Representatives as well as the Senate? They all can they as well can be a major factor on how much a president can accomplish during their term. Why might that be?
Yeah, absolutely. And remember, just because it's the same party doesn't mean there can't be disagreements. In fact, we did have a government shutdown towards the end of the last decade, even with Republicans occupying both chambers and, of course, Trump being president. So, yeah, I mean, if we're talking about anything, especially when it comes to tax cuts and any other sort of spending measures, Congress needs to be aligned with the president on that. But, given what we've seen with respect to the Republicans, it really does feel like Trump has molded the party in his image. So I don't think he's going to face as many barriers, at least if we're talking about some of the measures that he's talked about implementing. One thing I will mention, and I think this comes up a lot in conversations that I have with clients and other analysts on the street, is to remember also that, if we look at prior patterns from what we saw during Trump's first term, is that, when he's, giving his speeches and he's starting off and stating his positions, those tend to be his starting points. And then eventually, he's a very transactional person. Certainly, we've seen that over the last several decades. So, because he is dangling the 10 to 20% tariff, do not be surprised if we get something a lot less than that, or potentially an agreement where there are no tariffs, provided that there is a concession made by the other party as well. So that, goes for the U.S.'s negotiation with other countries when it comes to trade policy and tariffs, and also internally as well, if we're talking about the president negotiating with Congress.
Mm-hmm. That tends to be a pattern in U.S. Election, U.S. politics as well. You start at the extremes during the primary process, and you migrate back towards the middle. And let's not forget, President Trump does enjoy making deals, so that he needs to be able to find some common ground, typically, to get that done. I want to take a bit of a step back to talk around investor impact. Obviously we're a Canadian program. How could the Canadian U.S. dollar how can that be affected? And is there an opportunity that we might need to look towards some sort of hedging strategies?
Yeah, absolutely. I mean, if you look at the foreign exchange market and what drives currencies, and it's not an easy market to call because there tends to be several different drivers, and none of them really have stationary relationships with the Canadian dollar. So we tend to talk about regimes more often than not. One of the most important ones is the degree of divergence between the Federal Reserve and the Bank of Canada. Now, the Bank of Canada, it tends to set policy according to what's happening in the Canadian economy. But let's not also forget that the Canadian economy does tend to rely heavily on economic cycles in the U.S. And of course, that shows up in Canada via the trade channels. So if we are in this sort of scenario where the Federal Reserve is having to deal with stickier inflation than usual and potentially a higher equilibrium level of interest rates, that doesn't necessarily correspond to the Bank of Canada facing the same, especially if we're talking about other factors that tend to be exacerbated including the degree of private sector debt held here in Canada. So we could be in the sort of scenario where the Bank of Canada is cutting rates maybe a little bit more forcefully than we expect, whereas the Federal Reserve may not need to and is ending up with a shallower rate cut cycle. That will show up in the exchange rate. And over the last little while, we've seen the Canadian dollar weaken in anticipation potentially of a Republican-dominated Congress and Trump winning the election. Could we see more of that? Potentially. But then again, right now at this point, central bankers are being led by the data. And the data right now, it's on both central banks to cut. We would argue that the speed is probably going to be a little bit more quicker when it comes to easing in Canada. And that potentially could mean a weaker Canadian dollar potentially pushing above the 140 level if we're using the US dollar as the base currency of choice. Even above there, potentially into the 142 range would be something to keep an eye
on. Now, notwithstanding President Trump's maybe initial kind of dipping his toe into the crypto space, what do we think about how, in your opinion, how Bitcoin, how that could play out if we're going to continue to see rallies, or if there might be any changes or regulation coming down the pipe for that?
I mean, certainly changes in regulation have been one of the keystone points to what Trump has been talking about when it comes to the financial markets and with respect to crypto. So there could be a further upside from that lens. But let's also remember the reason why crypto is trading at elevated prices, and also by extension why we're seeing other assets like gold trade at these elevated levels, despite the fact that the U.S. dollar is quite strong. And that's for two reasons. I mean, we could talk about real yields in the long end till we're blue in the face in the relationship with gold, but again, that correlation is not stationary. Remember, we have a federal government in the United States that's running massive deficits, and so far, none of that has seemed to matter. So there tends to be this sort of feeling among some of the crypto bugs that there really isn't an upper bound when it comes to fiscal policy insofar as deficits are concerned. That's one risk. The other one is if we're looking at the Federal Reserve and the size of its balance sheet, that's expanded quite aggressively over the past 10 to 15 years as well. And again, there does not appear to be an upper bound there, right? So a lot of people tend to look at that and treat the sort of fiat regime that we've been operating in since the 1970s with some degree of suspicion. And, that I don't think is going to go away. So you take that in conjunction with some of the regulation that Trump has talked about, and yes, there potentially could be some more upside risk when it comes to crypto, especially insofar as Bitcoin is concerned. So certainly, that would be the prism or the lens that I would view that space going forward.
Now, some of the policies we've discussed from an economic perspective, such as taxes and tariffs, eventually do cause interest rates to go up or even inflation to increase. What are some of the sectors that investors would typically look to safeguard their portfolios?
I mean, it's rather tricky. If we're talking about potentially inflation remaining elevated, we're talking about interest rates potentially moving higher as well. I don't think that's a scenario in which you want to be in. The sectors that tend to rely on high dividends as drivers, including utilities. My own sort of inkling, whenever I look at inflation rising, is to seek protection in the form of gold or potentially even Treasury inflation-protected securities or the TIPS market. So again, inflation index bonds, gold, that tends to be the place that I tend to look when it comes to hedging against potential inflation risk. The equity market tends to be a little bit less reliable from that lens.
Now, if the Republicans do carry the House as is expected, that doesn't mean there's not necessarily going to be any political gridlock. Everybody's got their voters at home that they need to make sure that they're continuing to impress and to earn their vote for the next time around. And with the U.S. House system only on a two-year kind of round, that maybe that could lead to some gridlock. But how can an investor position their portfolios to benefit if there is some inaction or gridlock in Congress?
It's a very good question. But remember, if we're talking about gridlock, we're talking about government shutdown, they come in different flavors. Certainly if it's a standoff over the debt ceiling, that over time, as sad as it is to say this, the market has become less and less sensitive to it. So there doesn't tend to be as much disruption as it was, say, in the early part of the 2010s when, this was, for all intents and purposes, a relatively new phenomenon. But again, if we're looking over the next couple of years or even over the Trump presidency, can there be the potential for another government shutdown? Yes. They just happen so much more frequently now that we have to be cognizant of them. In those sort of scenarios, then, I would potentially looking out the yield curve of the United States and potentially going long duration in that sort of backdrop. Typically, that has provided the most amount of protection in sort of uncertain environments where we're worried about potentially a government shutdown and what that would mean for U.S. public finances and the economy writ large. And I don't think that's going to change anytime soon. Other than that, I would look at the gold market as well, potentially going long fixed or at least an asset like gold that doesn't tend to be as affected by aggressive monetary policy expansion and the printing of money. Gold tends to preserve its value relatively well from that lens. And I would suspect that that should be a similar theme to keep an eye on if we were to potentially go through a serious shutdown that was a little bit more prolonged than maybe the market was looking at. But I mean, one other thing I'll add to that, just having spoken and it coming into my mind, also remember that staying invested by large caps and using quality potentially as a factor can be a boon during that period as well. And certainly, if we look back to the prior shutdowns that we've had, we've seen quality outperform that environment.
Good to know. All right, now we've heard a lot of interesting perspectives on our program in the past, so we're gonna dig into the vault here. I would like to bounce some of those ideas off you to see if you agree or disagree and why that may be. This one here comes to us from renowned contrarian investor Benj Gallender. He suggests that U.S. stock markets tend to perform well in an election year, so investors may want to position their portfolios accordingly.
I said at the beginning of this year, it was very likely that stock markets would do well, because in the States in presidential years, the stock market almost always does well, because the powers that be want to get reelected. So they might not necessarily be acting for the best reasons. They're acting for reasons that make people say, wow, these guys are doing really well for us, and the economy is doing well, and I'm doing well, and therefore I will vote for these people again.
So Bipan, is bullishness in election years a trend you've also observed in past, and is it one that's worth positioning a portfolio for?
I mean, there is a theory known as the presidential cycle when it comes to stock markets, and certainly during some cycles it has more bearing than others, and especially if you have a president that speaks to the stock market and uses that as a barometer for success, then yeah, I mean, if you're looking at it from that prism, certainly it makes sense. If you listen to what Trump says about the stock market and potentially what measures he's going to implement, that's something that does tend to be the case. We do see equity markets up at the 1 year after Trump got elected in 2016 to 2017. We had, I believe it was a 20% year for the S&P 500. So positioning it from that lens, the lens of you have a candidate that is very sensitive to how equity markets are performing, that does make sense. But I'm always very leery about using one presidential cycle and comparing it to the next. I just don't think that's an effective strategy on the whole, or certainly something that shouldn't be automated over an extremely long period of time. But for this president, I do think there's merit to it, and that's something that all of us are going to have to remember.
I'll throw out one of my favorite quotes. It's not necessarily about the economy per se, but I'd like to try to draw some conclusions. This one's from Mark Twain. He said, "History doesn't repeat itself, but it often rhymes." So maybe that kind of plays into what Benj was saying in his clip.
I think so.
All right, just a quick reminder to our audience. You can, pardon me, go ahead.
No, I think that's a fair assumption. I mean, there are patterns in the way that markets tend to move over time, but let's also remember that the fundamentals matter a lot more, right? So what is the Federal Reserve doing? How is the economy doing? Are there any sort of shocks that we need to be cognizant of? That is the sort of those are sort of the factors that could disrupt some of the pattern recognition behavior that some investors ascribe to.
Yeah, and Warren Buffett says as well, right? You're not just buying stocks; you're buying companies too. So we need to that kind of circles back to your point of fundamentals. We want to be looking at, you got strong companies that are there. They're going to be there tomorrow and next year and the year after that. Right?
Agreed. Yeah.
All right, just a quick reminder to our audience. You can find a link to episodes we've referenced here in our resources section of the broadcast console. So make sure to check it out before you go. You can also find it in our Learning Center on WebBroker as well as TD's YouTube page. All right, we're going to have to leave our interview portion of our conversation there, but we're not done yet. We're going to open up the floor and take your questions from our viewers. We're ready to hear from what our audience wants to know more about. All right, and Just a quick reminder, we've got our Q&A box up on our console here. Go ahead and get your questions in, and we'll be happy to tackle as many as we can. And once again, as a reminder to our viewers on YouTube, if you'd like to join in and ask a question, click the link in the description, and you'll be able to jump in and take a look there. All right, so our question here is coming to us. First one, let's bring that up. Let me see here. We got, looks like this one is Bill. Bill wants to know, how long do you think it will take before we have all of the results in from the House and Senate races? Look into your crystal ball.
I mean, we should get that in the next couple of days. I would say by early next week, we'll have a good feel for whether or not the Republicans are going to retain control of the House. I mean, that's an educated guess I have, speaking to people that are much smarter than me and much more in tune to what's happening on the ground in Washington.
That's true. Now, I know we've had like concessions from Kamala Harris, how she's already put in that reset. But there's also sometimes there's legal challenges, and there's waiting on mail-in votes and absentee ballots that need to come in. So it's as much as we live in a kind of an instant gratification culture, sometimes we need to just wait.
Yeah.
All right, next question comes to us from David. David wants to know, Trump has expressed support for increased oil and gas drilling, just like you said, drill baby drill. What sort of impact could that have on the energy sector?
So that's interesting because, if we're talking about the U.S. energy sector, there's offsetting that energy sector as well. Yes, I mean, you would have this sort of push towards deregulation, drilling more. Remember, there's offsetting measures there. You drill more, you produce more, that's going to have an impact on prices. Right, so at the margin, you're getting some downside risk from there. But again, you have more potential, activity that leads to more investment when it comes to capital, expanded revenue opportunities over time that all of a sudden now get discounted forward. That could be an offset in terms of higher prices over the near to medium term. So again, there's sort of that push-pull effect. I would say that based on the sort of rhetoric that he's espoused of drill baby drill as an easy cash trade to latch onto, that for the energy sector, at least in the near term, I think it's supportive. And certainly, if we look at the markets of late, that is something that we expect to see as a theme to keep an eye on. For Canada, we have to pay attention to as well whether or not we're going to see Canadian LNG producers potentially get more export to, or get more access to U.S. ports. And that is going to be a decision that is made by the Republicans in Congress and also by President Trump as well. So it could be quite beneficial for Canadian producers from that lens, I would say.
You must have anticipated this question coming. Elena had a follow-up to that, wanting to know what the impact on the Canadian oil and gas sector. Are there any other kind of follow-on effects that we think we can add to that for the Canadian oil and gas?
I mean, there's many. I think when it comes to the sector and what we've seen so far, I think it's kind of safe to stay within that realm for now. Other than that, we'd have to do a little bit more thinking because there's so many different permutations that could be taken here from here. What the Trump administration could look.
What about like the pipelines and things like that, kind of pulling the thread? Where do we think that is going to be impacted?
Good question. And simply, I don't have an answer for you at this point. So far I've thought about it from the producers, but pipelines could also be an interesting fabric, especially as I mentioned earlier, if there is a sort of push potentially to expand access to some of the U.S. ports for Canadian producers.
All right, great. All right, next question. This one is from Alice. Alice wants to know, Trump has expressed a desire to repeal Biden-era regulation that encourage a shift to electric vehicles. What sort of impact could that have on the automobile industry? Now, he might need to run some things by his good friend Elon, who might potentially be in his cabinet. So, but yeah, what are your thoughts on that?
If we do see that, I think some of the repeal that we're seeing is more related to clean tech and more exposed to sort of the clean energy push that Biden or at least the Biden administration espoused. I think that's where it's being felt more first and foremost. I don't think it really is just all about electric vehicles. And for the reason that you mentioned, Jason, I mean, I think Elon is going to be a strong voice in the Trump administration to potentially curtail any downside risk to electric vehicles. So, if you're asking me how Tesla is going to perform, I have a hard time seeing it underperform, even if Trump is going to repeal some of those Biden-era regulations, I would say. I think those are more targeted towards clean energy insofar as other industries are considered. not so much electric vehicles, in my view.
Yeah, speaking to Elon Musk, maybe just a little bit as a follow-up, more around kind of like cost cutting within the U.S. government. Does kind of like looking for efficiencies in the government, or even removing some of the I guess like moving away from career U.S. I guess employees, does that have like a carry-on effect to like larger issues like the federal debt and things like that, or are those issues not really connected?
I don't think there's a direct connection with them. I do think over the medium to long term, there are political sort of extrapolations that we can make that probably wouldn't suit us if we were to continue down that path in this conversation. But no, to answer your question, Jason, I don't think there's a direct connection between that and government debt. I think really the driver of government debt are other issues beyond, say, bureaucracy and civil servants that have been there for more than one administration.
All right, now this next question, this one is from Dimitri. This is a bit of a geopolitical kind of hot button, and a lot of people are trying to kind of thread the needle on this one. So Trump has suggested he would seek to end the war in Ukraine and offer less support to NATO allies. How might that impact the defense industry, and would have any knock-on effects in any other sectors? So that's quite a loaded question there, Dimitri.
I mean, we saw a lot of that in his first term, and it did create some fissures when it comes to the transatlantic relationship between the U.S. and its European partners. At the margin, I do suspect that is a way for Trump to sort of exert pressure on the Europeans to increase their defense spending. And it's not just the Europeans, it's also Canadians as well, potentially, because don't forget, we do have the USMCA agreement that is going to be due for review in 2026. And there's a lot of speculation that we could see, the Trump administration dangle tariffs as a potential threat to Canada and potentially Mexico as well, although Mexico is not a part of NATO, to potentially in exchange for increased defense spending. So, and alongside other measures as well. So I do think when it comes to defense in general, I mean, the pressure, or at least the rhetoric from the United States, is going to be that you have to keep up with what they've been doing for decades now. So from that lens, it could be quite beneficial for the defense industry in general. Now, when it comes to ending the war in Ukraine, I don't have a particular view there myself. I mean, I tend not to, when it comes to geopolitics and those sort of conflicts, I tend not to take views just because, they don't tend to really filter through to markets unless we're talking about commodities.
And speaking more from a Canadian perspective as well, along the line from a tariff perspective, how does those tariffs work within the structure of NAFTA? And that was renegotiated, very recently, and like how does that play out?
Yeah. So I don't think, if we're talking about the IEEPA tariffs, and you'll have to forgive me, I don't exactly remember what that acronym stands for. This is something that was, I believe, is an emerging, the last three letters in that was Emergency Powers Act. And that was really granted to the Office of the Executive under Carter in the late 1970s. And that basically gives the president the ability to raise tariffs on any country that he chooses to do. Now, what Trump has threatened is sort of this, immediate import tax on all imports to the United States on the order of 10 to 20%. I don't think those would be applicable right away under the USMCA agreement. Correct me if I'm wrong, and that's something I'll have to fact check myself on. But he could use that as sort of a negotiating ploy if we're talking about entering into a review when it comes to the USMCA, which is expected to, as I said earlier, is expected to be placed under review in 2026. So, if you could go to whoever the prime minister is then, and basically say, look, if you want to carve out from these 10 to 20% tariffs, you're going to have to do this, and then we can extend the USMCA agreement from that lens. So, that's how I would look at it. I don't know exactly whether or not he can do that legally under the current USMCA framework.
Yeah, it'll be interesting to see how it plays out. And the audience will have to forgive me. I got my acronyms mixed up, and maybe that's dating myself with NAFTA. But yeah, USMCA, that's what we're working with now. All right, next question comes to us from Stephen. Stephen wants to know if Trump takes the U.S. into a more isolationist direction, what do you think that means for emerging market stocks on a longer term?
There'll be considerable headwinds for sure. Let's not forget that the era of free trade was also the era which we saw activity pick up from an economic perspective in a lot of emerging market countries. And, I'm not just talking about Mexico there, I'm talking about Latin America. There's a lot of imports, or at least exports, I should say, to the United States. And of course, slowly over time, as we saw China gain entry to the WTO in 2000, did go to China, and China became the factory for the world, to use a common phrase. But if we're entering into this sort of world where the U.S. is headed into a more isolationist direction, that's a considerable headwind for emerging market stocks and emerging market economies writ large, and something that potentially could impact the way that those trade. But I don't think the U.S. is going to be 100% isolation. I think that's the wrong word to use. I mean, when I think of the word isolationist, I think of the era of the United States before Teddy Roosevelt was president in the late 1800s. It was dominated by tariffs, trade beyond its borders. I don't think we're headed in that direction. I think we're headed towards more of a regional trade bloc direction, right? So it's not going to be the era of free trade of the 90s and 2000s. Instead, it's going to be geopolitical trade blocs, right? So who's aligned with the U.S. from a geopolitical lens? And, is there sort of a trade agreement there in place? Now, that could be something that is important for us in North America, obviously. We'll have the U.S. as a trade partner. I don't think that relationship is going to change. Mexico will still potentially be operating under that framework as well. But if it is a North American trade bloc, we have to consider that Mexico signed a lot more free trade agreements over the past 10 to 20 years than Canada has, and that could impact them from an import cost perspective if they're negotiating with the U.S. So, to me, that's the framework that I would use. It's a significant headwind, but also remember, emerging markets in that world don't all trade at the same speed and pace.
All right, it'd be interesting to see how it plays out. Our next question comes to us again from Elena. She's got a number of good questions coming in here. Just a bit of context. This is probably focused around kind of RFK Jr. statements and his potential involvement in the administration. He discussed cutting, big cuts to the FDA, and there's been floated, bans on vaccines as well. So kind of what do we think the election's impact on the health sector will be?
So I'm going to disappoint Elena, and I'm going to say not sure at this point, to be honest with you. There's a lot of known unknowns there that we need to sort of sift through before we can come up with a definitive explanation for how the health sector is going to perform under the next Trump administration. So that's something we would bookmark and potentially come back to.
Yeah, absolutely. It's one of those things. We've got, 18 months of kind of like of discussions and talking points that have kind of come out of the election, but nobody really knows. We need to see how these things are going to play out, in real time, and how they would be kind of implemented in the real world. So that brings us to the conclusion of our conversation. So it's been a lot. It's been enjoyable to hear your takes on this, Bipan. Do you have any closing thoughts for the audience you want to leave us with?
Yeah, and I'll just sort of dovetail onto to sort of answer the last question. Is remember, this is a very, very constructive environment for broad equities. And if we're talking about certain sectoral plays and what could happen for certain sectors, including the health sector under the next administration, we're still talking about potential upside. It's just a matter of beta, whether or not they're going to outperform the broader index in general. The prior experience shows it's probably better to remain invested using the broad market index as a barometer writ large. And I don't think that's going to change over the course of the next year or two under this administration. So I'll just leave it at that. I mean, stay invested. The U.S. still offers a ton of potential, and that's the market potential that we're looking at now. It seems an outperformer.
All right, great. Bipan, it was a pleasure to hear from you, and I really enjoyed your insightful comments about kind of this election cycle and its impacts on the economy. And to those in the audience, keep in mind, there is a survey at the bottom of the screen. We'd love to hear feedback from you. We're going to be producing these programs essentially on a weekly basis. So we want to hear what you thought about this one, and maybe even give us some suggestions of topics that you'd like to have in the future. As well, keep in mind our upcoming events over the next few weeks are posted down below. Go ahead and check those out. We'd love to see you and hear from you at our next event. With that being said, thank you so much all for tuning in, whether or not you were in our web broker platform or on YouTube. Thanks so much. Have yourself a wonderful rest of your day. Have more questions? Check out the links to the right and in the description below.